This video provides a clear-headed analysis of the FPI outflows and market shifts in 2026. We will look at the macroeconomic drivers behind the 2.2 lakh crore capital flight and identify the Indian companies set to benefit. The May 2026 crisis is defined by two key factors. First, massive capital flight saw foreign portfolio investors pull out over 27,048 crore rupees in May alone. Secondly, the persistent foreign capital exit and widening current account deficit caused the Indian rupee to fall sharply to 96.14 per USD. Looking at monthly FPI equity flows in 2026, February was the only month with inflows. However, the subsequent months saw sharp reversals, culminating in significant outflows by May. Three main drivers are prompting FPIs to pull out capital. High U.S. yields and a stronger dollar attract capital to developed markets. Global and local uncertainty, including geopolitical tensions and high oil prices, reduces the appetite for risky emerging assets. Finally, delayed rate cuts by global central banks make borrowing costly. The Indian rupee is under significant pressure, depreciating rapidly from 90.00 at the start of 2026 to 96.14 by mid-May. While this raises costs for importers, the depreciation is a massive tailwind for export-oriented businesses. A falling rupee and shifting FPI priorities do not affect everyone negatively. We will now identify the Indian sectors and companies that are well-positioned to benefit from these developments. IT and software exporters are a primary beneficiary. They enjoy a USD billing advantage, receiving revenue in dollars while paying expenses in rupees. This currency difference provides a direct margin boost, benefiting giants like TCS and Infosys. Indian pharma also thrives on global exports. Companies like Sun Pharma and Cipla see their international realizations rise dramatically in rupee terms when the currency depreciates. Their heavily localized supply chains minimize domestic impact. Domestic market platforms are the third beneficiary. A strong SIP culture protects mutual funds like HDFC AMC and Nippon Life from FPI shockwaves. Market volatility boosts trade volumes for platforms like BSE and CDSL. Public sector banks also remain safe havens due to high domestic deposit. Our sectoral impact assessment shows IT services and pharmaceuticals as highly positive. Market infrastructure is neutral to positive. Conversely, oil and gas imports are negatively impacted due to rising crude oil import bills with the dollar strength. A key factor driving outflows is the fund diversion to global AI markets, primarily in the U.S., with high capital attraction. As money is actively diverting to these global AI trades, a cooling of this trend could potentially reverse outflows back to India. The FPI selling tide could reverse when the U.S. cuts rates or the global AI bubble cools. Until then, export-led companies and domestic financial institutions remain our strongest defensive plays in the market.